Most people spend hours comparing term plans, sum assured, riders, claim settlement ratios, but completely skip one of the most crucial decisions. How long should you keep paying premiums for? Because 1 crore term plan can cost 10,000 rupees per year for 40 years or 25,000 rupees per year for just 10 years. Same plan, same coverage, but two different payment strategies. So, which is smarter? Do you keep it light with regular pay or wrap things up early with limited pay? Hi folks, I'm Shashank and you're watching Ditto Insurance. In today's Term 101 episode, we'll help you figure out which payment mode makes more sense for your life, your income pattern and your financial priorities. And by the end of this video, you will know exactly how to think about this decision, not just in terms of cost, but in terms of control, peace of mind and long-term planning. And if you need our help in selecting the right health or term insurance plan without any spam, then book a free call with Ditto's IIDI certified advisors with the link in the description. It'll take just 2 minutes. Our services are free and we promise a spam-free experience. Alright, let's compare these side by side. Regular pay is simple. You pay your premiums every year for as long as your policy runs. So, if your plan is for 40 years, you pay for 40 years. In limited pay, you finish all your payments in a shorter time, say 5, 10 or 15 years. And after that, no more premiums, but your coverage continues for the full term. Regular pay keeps your annual premium lower, which is great when you're just starting out, managing EMIs, SIPs, rent and other obligations. Limited pay is clearing your dues upfront and coasting you through the rest of the ride. This is incredibly useful if you're in your prime earning years now or you expect income to reduce later. Maybe you want to retire early or just don't want to think about insurance payments for the next 30 years. Regular pay gives you flexibility. Say if your financial responsibilities reduce later than expected, you can stop paying and let the policy lapse without feeling like you've wasted a large upfront amount. Limited pay works great from a lapse protection perspective, since in regular pay you'll be paying premiums well into your 60s or 70s. Now, if something disrupts your income then, like retirement, illness or job loss, it can become harder to keep up with the payments. But in limited pay, once you're done paying, there's no risk of the policy lapsing because you forgot a payment at age 67. The policy stays active, the protection is intact. Also, from a behavioral standpoint in regular pay, you're never really done. Every year, the payment reminder comes back. You're insuring your death again. For some, that mental loop gets tiring. Psychologically, limited pay gives you closure. There's peace in knowing that this one's done, it's off my list. But here's what you need to consider. Limited pay costs more upfront. You're compressing 30 or 40 years of premiums into 10 or 15 years. So your annual premium is much higher. And if you cancel the policy midway, say in a year 4 of a 10-year payment, you've already sunk in a lot of money with very little to show for it. It also reduces your liquidity in early years, which could impact your ability to invest elsewhere or deal with unexpected expenses. Alright, now let's compare them with a quick real-life example. Say you're 30 and buying a 1 crore term plan till age 70. With regular pay, you pay 10,000 per year for 40 years. Total outgo is 4 lakhs. Now with limited pay for 10 years, your annual premiums might be 25,000 rupees. Total outgo is 2.5 lakh rupees and you're done in a decade. So yes, limited pay is cheaper overall, but it's harder on your budget upfront. Now, let's say you face a financial crisis in year 6 and cancel the policy. With regular pay, you've paid 60,000 rupees. With limited pay, you've paid 1.5 lakh rupees and here you lose more. So the real question is, are you someone who likes to stretch costs out slowly over time or someone who prefers to get done with obligations early while income is high? There's no universal right or wrong answer for this, but there's a right answer for you. And if you're still unsure, then this is where Ditto comes in. Book a free call with our advisors. We'll look at your age, income, expenses, and future goals and help you figure out whether regular or limited pay is a better fit for you. We promise you no spam and we won't pressure you to buy from us. We'll just give you clarity. The link is in the description. Oh, and before we go, there is one last thing. There is also something called as pay till 60 option. And here the insurer will tell you, here, finish all your payments by age 60 and your cover continues beyond that. Now, it's a perfect option for people who want to be done before retirement but don't want the high premiums of a 10-year limited pay. Now, There's also one more thing, and that's called single pay, where you pay one lump sum and never worry about premiums again. Great if you've received a bonus or inheritance, but less flexible overall. Let's wrap this up. Regular pay is ideal if you want lower annual premiums and prefer spreading the cost. It's especially useful if your income is still growing or variable. Limited pay is ideal if you have surplus cash and want peace of mind and prefer not worrying about payments later in your life. Especially powerful if you're financially disciplined and thinking ahead. Whichever one you pick, make sure you choose consciously. This one decision can change how your policy feels for the next 30 years. Folks, in the next episode of Term 101, we'll cover a scenario that confuses almost everyone. What if I miss a premium or my policy lapses? Can it be revived? What will be the cost? Will I need to do medical tests again? All of that coming up in the next episode. Until then, happy insurance hunting.